So it's been a tricky day today for the tech stocks. This year's big winners, such as Nvidia, AMD, and Palantir, have seen selling in their shares. We're also, of course, assessing the latest retail earnings. There's disappointment that Target hasn't brought in an outsider as the new CEO. Let's get more from Jack Manley, Global Market Strategist at JP Morgan Asset Management. Great to see you. Really appreciate it. Talk to us first about this weakness in tech stocks. I mean, nothing goes up forever, I know.
I think that is going to be part of it, right? Of course, we're going to need to see some profit taking here. Investors want to pause and wait and see what the longer term prospects are for some of these names. But I do think it's important to sort of understand, how did we get to this place right now? When you look at what happened to the S&P 500 in 2023, what happened to the S&P 500 in 2024, both of these years were extraordinary years, 20+% returns. But the Magnificent Seven, these kind of AI-focused tech names, accounted for 60% of those returns in both of those years. This year so far, close to 50% of those returns that we've seen, of roughly 10% again so far in 2025. And they've done that largely through massive multiple inflation. And when you have so much index concentration, so much riding on such a small handful of names, and when you have multiples this lofty, I mean, arguably somewhere in the stratosphere, it doesn't necessarily mean that things have to go wrong, but it does mean that you're a lot more susceptible to shocks. And earlier this year, it was DeepSeek Monday. I'm sure you remember that Chinese company coming out with their own AI prospects. More recently, it's been some testimony in Congress, an academic white paper that was published. I don't think this derails the long-term tech trade, but it is an example of maybe a little bit of this excitement just getting let out while we bring ourselves back down to earth, I guess is how I'd put it.
Just remind us, what was that economic research you referred to there, Jack, please?
Academic research, so a paper coming out of MIT about how many of the investments in generative AI aren't necessarily paying dividends, so to speak, which is alongside a few other pieces of research that we've seen really over the last 7 or 8 months, this idea that the Magnificent Seven, in particular the hyperscalers, the biggest players in this space that are investing like crazy in the artificial intelligence arms race, are spending hundreds of billions of dollars year in, year out on trying to quote unquote win this thing, but are their profits up hundreds of billions of dollars, right? Is there a commensurate increase in earnings alongside all this spending, or has all this spending sort of not been for a whole lot of anything? And the paper seemed to make the point that a lot of these companies don't have a whole lot to show for it.
Yeah, I mean, Zuckerberg at Meta is going to build one data center, just one of them. It's called Prometheus, a pretty grandiose name, and it'll be nearly the size of Manhattan, according to the BBC.
Impressive. I mean, you've seen a lot of interesting headlines like that. I think another interesting one is the announcement of some of these big tech behemoths making investments into a almost nuclear renaissance in the United States. This idea that all this AI, particularly on the generative side of things, requires enormous data centers to make those computations possible, and those data centers are extremely power hungry, and no combination of oil or gas or coal or even solar or wind will be able to fuel those electricity requirements. Nuclear might just be the silver bullet here. So a lot of really interesting headlines about private investment into infrastructure like the ones that you were talking about from these big tech names.
And you've probably seen our own Canadian Brookfield, a huge player in building out these AI data centers and the power required. When big clients come to you, Jack, and I know it's very hard to generalize here, but if they say, look, should I underweight the Mag 7? What should I do about these stocks? Do you have a general answer for them?
So I have to admit I'm a little bit biased here. I don't know about you. I am sick to death of talking about artificial intelligence. So already leaves a little bit of a bad taste in my mouth to have those conversations, right? But if I put those biases to the side, I'm not necessarily looking to ditch the Magnificent Seven. I know that's not your question, but I do want to bring that up. These are not, at least for the most part, these are not companies that were cooked up in some guy's garage, a month or two ago. This is not the pets.com bottom of 2025. These are real, durable companies with multinational footprints, proven track records over the course of decades of innovation, strong cash flow, strong balance sheets. These are not companies that are going under anytime soon just because of one or two bad headlines. But I do also think at the same time, we are seeing earnings growth in the S&P 500 expected to broaden out this year. We've already seen some evidence of that. We expect to see it broaden out further next year. So from my perspective, the story that we're telling is not, get rid of the Mag 7 and focus in on everybody else. It's about just embracing this bigger opportunity set that we haven't really been able to embrace for the past few years and lean heavily on bottoms-up security selection, on active management. That's how you stay constructive on a U.S. equity market that's pretty frothy from a price perspective, has pretty stretched valuations, and as we were just talking about a little while ago, has the propensity to undergo short-term but somewhat intense corrections.
You have an interesting take here on the U.S. labor market. We should remember, if I have it straight, you say we should remember that there's a restricted pool of workers, availability of workers in the States?
Yeah, so that's a new sort of dynamic that we've been seeing more and more in recent labor prints, and it is particularly relevant because, of course, the most recent U.S. jobs report from a couple of weeks ago was enormously disappointing, right? Those payroll gains numbers were significantly below expectations for the month of July. Way more troublesome were the significant downward revisions that we saw to June and May before it. We've actually brought now the 3-month running average of payroll gains to a paltry 35K. That is a far cry from where we were a year, 2, 3 years ago. And I think a lot of people look at those payroll prints as evidence that the economy is slowing down a whole lot. But that's where this labor supply situation comes into play. The United States, like Canada, does not have particularly good domestic demographics, right? Both of our countries, most of the developed world, is experiencing an aging population, the baby boom rolling out of the workforce, the birth rate continuing to decline. Here in the U.S., we now have an additional complication in the form of significant changes to immigration policy. And if you are talking about a real restriction in the growth of the labor supply, businesses may still want to hire, but they're having a harder time finding that labor. And I think that helps to explain a little bit of that softness in recent payroll data as well. It also helps to explain, while even though that report was disappointing from a payrolls perspective, the unemployment rate is still extremely low in the United States by historical standards, and wage growth is actually still quite firm.
And you referred, I guess the irony is we're running out of young workers, but in this country anyway, unemployment among young workers is near record levels. It's really tough to get an entry-level job, it seems.
It's extremely difficult, and I will tell you, just using sort of anecdotal evidence, and I love anecdotes, so I feel free to share them. I hear from a lot of people on social media, looking for tips and tricks about how to get into the labor force. This seems to be a phenomenon really in both of our countries right now. This idea that it's extremely tough to find a job right out of school, and maybe AI is contributing to that, right? A lot of that junior talent. That work is now easily replicable by a program, even an inexpensive one. I think a lot of it also has to do with a lot of this uncertainty around the size of the pool of labor. What you'll notice is that, yes, companies aren't hiring a whole lot, but they're also not firing a whole lot. And so it's one of these situations where if you have a job, you're probably in pretty good shape, and you're unlikely to lose it anytime soon. But if you do lose it, or you don't have a job to begin with, like say you're a recent graduate from university, you got a real uphill battle to climb, or an uphill battle to fight, I should say, before you're able to secure employment. It's a really tricky situation.
Jack, I could talk to you all day. Apparently, research shows that job interviews are very ineffective at finding the right candidate, but they are beloved of HR professionals.
I think that's probably true.
We'd better jump. Jack, thank you very much indeed for giving us the time.
Thank you. Great to see you.
Jack Manley, Global Market Strategist at JP Morgan Asset Management.